The South African Revenue Service plans to introduce changes to calculate the effective tax rates of people who receive multiple incomes, including retirement funds. The changes will be introduced from the 1st of March next year. But how will this affect you? To discuss this, we're joined by Pieter Faber from the South African Institute of Chartered Accountants. Peter, there are few things that vex people as much as tax. So please expand on us exactly what SARS will be introducing.
Good morning, Tafuma. Yes. Well, I think this thing, when it was introduced, it was actually introduced back in 2019. It just had a bit of a delay because it impacted on the administrative systems of pension funds and insurers quite a lot. So in a nutshell, what SARS are trying to do is saying, well, because we have a sliding scale of tax, so what that means is you don't pay at a fixed percentage. So if you have multiple incomes, they all get aggregated or added together, and they actually push you higher up into the bracket, which means that if I had to tax it individually, so employer A or pension fund A and pension fund B, they would actually look at it individually and tax you at that rate. But if you add them together, you'd pay more taxes. So this proposal is essentially saying, well, if you receive a pension fund where the pension fund wouldn't see it, and you, for example, still have employment, SARS could now actually look at both and instruct the pension fund, who would now have to apply on an annual basis for a directive to say, don't give the primary, secondary, or tertiary rebates. So that's the annual amount you actually get off as a rebate. And they actually then can give that and tell them not to give that rebate, so that your actual tax liability at the end of the year is, to a large extent, a lot more aligned to what your real liability would be.
Why is this necessary, Peter, and is it helpful in the end to the taxpayer?
Well, when we looked at the example in 2019 that SARS had raised, it was firstly on the basis of, call it surviving spouse, so where I had a spouse passing away and I had to receive their pension as well, even though I might still be in employment or receiving a different pension, and therefore it doubles up. And it then results that come at the end of the year, because you had now under-deducted or calculated the tax at a lower rate than it should be, invariably when you get assessed, you had to pay in a lot of taxes. And on this basis, SARS then made the proposal, say, well, let's change the law so when you've got multiple sources of revenue, and this will only apply if you're either in employment or in pension, and the reason being that if you have trade income, let's say you still run a business, you'd be a provisional taxpayer and you'd actually do this calculation on your own, where if you're in employment or receiving pension, you actually don't see it, and the underlying funds and employers actually don't see those aggregated amounts. So I think the only concern we have on this is, and that will be in the detail, which we don't see past 1 March, is whether, especially for the elderly, whether medical expenses will be taken into consideration as well in this calculation, because a lot of time that does reduce your actual effective tax rate quite a lot. So we'll have to see that post, because the law in itself doesn't actually say anything about that specifically.
Yeah, so it could be beneficial in that it'll prevent you having to pay a lump sum at the beginning or at the end of the year when you have to pay what you owe to SARS. Now, does this apply, Peter, to other, say, independent contractors who have multiple streams of income? No.
So invariably, the reason being that if you have other income rather than remuneration, you're not within just the pay-as-you-earn regime, you're what we call the provisional tax system. So that's a system where you, on a 6-monthly basis, actually calculate what your taxes would be, and you then pay your pro-rate share to revenue. So this will only, from what we've seen and what the legislation tries to achieve, apply to people who receive pension or retirement income, and also if they have other annuity or remuneration where they should be withholding in some form of fashion that is pay-as-you-earn.